Hello everybody, my name is Alesh Eisner and welcome to the Canadian Money Talk, the channel about Canadian investing and personal finance. Please like and subscribe. I record 2 videos per week, so make sure you ring the notification bell to get notified each time one comes out. In this video, I will go through some common investing sayings and quotes and explain what they mean in common English and comment on them. See how many you recognize. And for the record, I will not insult you with buy low, sell high. No one ever lost money taking a profit. This one usually comes up when somebody complains that they sold an asset that was going up in value and it continued going up after they sold it and they missed out on profits. Since with most assets it is hard to tell when they're at the top, you have to sell when you've made some money and don't be greedy. Since you don't know where the top is and you can't see the future, be happy with the profit you made. But otherwise, it is always true that nobody ever lost money taking a profit. Don't fight the Fed. This saying is investment policy that suggests investors should align their choices with the actions of the Federal Reserve System, or the Fed. Aligning with the Fed generally means buying stocks when interest rates are low and avoiding stocks when interest rates are high. Recently, the Fed has been lowering interest rates and also buying bonds to keep interest rates low. And so investors are expecting the market to go up. Low interest rates are typically good for most companies, lowering their debt costs and encouraging people and other companies to borrow to buy more. So when the Fed is lowering rates, you should be buying stocks. Bulls make money, bears make money, and pigs get slaughtered. One can make money lots of different ways in the market. The bulls, who expect the market to go up, can buy stocks and watch them go up. The bears, who are negative on the market, can short stocks or buy puts and make money that way. Pigs, however, are greedy investors whose goal it is to make the most amount of money in the shortest amount of time, and they don't know when to sell and take their profits. Piggish investors are known to either take on high degrees of risk or overlook risk in order to make a profit. They often make rash investment decisions and buy stocks without doing their proper due diligence. As a result, they tend to lose money, hence the adage that they inevitably get slaughtered. The market takes the escalator on the way up and the elevator on the way down. This saying means the market grinds its way up, hardly ever shooting up, so it is going up slowly like an escalator. When something bad happens, however, there's a panic, and everyone sells at once, and the market loses value quickly, as if going down an elevator. As Kevin O'Leary says, it doesn't touch the sides on the way down. Markets can stay irrational longer than you can stay solvent. This is a John Maynard Keynes quote. And it means that markets over the long run will get their valuation correct according to the current situation. In a short run, however, investor emotions take over and they panic with fear or become greedy and do irrational things. The saying means that irrationality can hang around for a while. If you think the world is ending, you should be buying canned goods and ammunition. In all other instances, you should be buying stocks. Markets will panic and lose a huge amount of value on occasion. This is where a buying opportunity happens, because the market will always go back up to new highs in the long run due to increasing population, inflation, better technology, and process improvements that make companies more efficient. So when things seem the bleakest is where the buying opportunity is the best. If our society is about to cease to exist, you should be buying supplies to allow you to survive in a post-apocalyptic dystopian society. If our society will recover, the stock market will eventually return to new highs, and you'll be happy you bought stocks. This time it's different. The four most dangerous words in investing are "this time it's different," according to John Templeton, the highly regarded mutual fund manager. As stock market tops and bottoms, investors invariably use this rationale to justify their emotion-driven decisions. As Mark Twain says, history doesn't repeat itself, but it often rhymes. Different things get thrown at the market to cause people to panic and think, as per the previous saying, that the world is ending this time. The world isn't ending, it just feels like it is. Those that can keep their heads can make a profit. This next one is a 2-for-1. Number 1 is don't try to catch a falling knife, and number 2 is just when you think the stock can't go down anymore, it goes down some more. Now the two sayings are related. The second one is mine, if I can take the credit. The suggestion not to try to catch a falling knife is telling an investor not to buy a stock on its way down and instead wait for it to bottom. There's no way to know where the bottom is, so some people will guess at it and believe the stock, as soon as they buy it, will do nothing but go up because they timed it perfectly. The amount of self-confidence required for this belief is significant and works about as often as trying to catch a falling and churning knife. Sometimes you catch it cleanly by the handle, and most of the other times you'll get cut or stabbed. This is where the second saying comes in. I've often bought a stock thinking there's no way for it to go lower, and it did, many times, 30% lower. That's why it's better to wait for the stock to hit some sort of a bottom and then buy half of it that you want to buy before the bottom, and then buy more on the way up. Or buy some of it on the way down when you think the stock is a great deal and keep buying it as it goes down further and maybe a bit more on the way up. In the short run, the market is a voting machine, but in the long run, it is a weighing machine. This is by Benjamin Graham. The saying means that in the short run, people will freak out with fear or greed or think that they're missing out and buy and sell with their hearts and emotions, just like voting. Eventually, the market goes to the quote-unquote right level, and this is where the weighing machine, which knows the exact value of what things are worth, comes in. But as Keynes said, it would be a while for the market to become rational again. Know what you own and know why you own it, by Peter Lynch. This means you should do your homework before making a decision. And once you've made a decision, make sure to reevaluate your portfolio on a timely basis. A wise holding today may not be a wise holding in the future. The market is climbing a wall of worry. The market is always aware of some risk, something it is watching. It could be Brexit, it could be China-US relations, it could be a US government shutdown because they didn't pass the budget, it could be the virus, etc., etc. And as soon as a new threat appears, the old one is forgotten about, and the talking heads on BNN and CNBC have something to discuss and scare us with. And investors find something else to worry about and cause the market to go down a bit, or at least not to shoot straight up. If there were no fears, there'd be no buying opportunities. But despite the fears, the market continues to grind up. This is another 2-for-1. The most important quality for an investor is temperament, not intellect, by Warren Buffett, and the investor's chief problem, even his worst enemy, is likely to be himself, by Benjamin Graham. These mean that investing also requires a good psychology and avoiding being emotional, whether that's greedy, afraid of missing out, fearful, or panicking. If you are going to buy or sell an investment, do it for rational reasons, because you think it is a good investment or a bad investment, respectively, not because someone else thinks so. And frequent trading and selling at the bottom has sunk many a portfolio. If you have trouble imagining a 20% loss in the stock market, you shouldn't be in stocks, by Vanguard founder John Bogle. This speaks to knowing your own risk tolerance and being comfortable with what you invested in, even if it goes down. If you don't mind a smaller return, but with the benefit of less volatility, buy bigger companies or diversified portfolios, for example. And we'll end with the big one. Be fearful when others are greedy, be greedy when others are fearful, by Warren Buffett. The classic quote from Warren: get into the market when everybody is selling in fear, and get out when everybody is buying because they think they can't lose. This is related to a quote by Robert Arnott. In investing, what is comfortable is rarely profitable. To make money, you have to get out of your comfort zone, get your heart beating a little bit, and take a calculated risk. That concludes our investment sayings. I hope you've recognized a few and enjoyed the rest. If you have any requests on what you would like me to cover in future videos, please put that into the comment section. Please like, subscribe, ring the notification bell, and may you have a profitable day.